Alrighty, folks, it is frankly time to check if hell has frozen over. Two of the largest players in the real estate market have gone negative, and I would dare say bearish on the housing market in 2025. Zillow has actually gone out to call negative prices. Yes, folks, Zillow believes prices are going to fall in 2025. Redfin out with a survey talking about consumers backing away from the market, which it too could create its own set of problems. We're going to talk about all of this and more, but stick around to the end because we're going to talk about where the opportunity lies in this chaos. Lance, you were the first person I saw to break the news that Zillow has gone negative. What is Zillow saying, and what do we have to know? Is hell frozen over?
Yeah, so I put that headline out, hell's frozen over, really just because, Zillow has usually been lately predicting a mild increase in year-over-year home prices. And so now they've gone a little negative. So that's, a little bit of, just being a little spicy there, right? So, a lot of different asset classes falling on an aggregated basis, 1.7% year over year. A lot of like stocks, that's whatever, right?
Yeah. It happens in a day.
Residential real estate is historically known for stickier prices. So when you're in a situation where you have, prices for year over year on a national basis predicted to be down 1.7%, I consider that, relatively speaking, for this asset class, kind of a bearish. Right?
No, I agree with you. I mean, if you look at Zillow, you and I have been talking for years. I think Zillow's first call for 2025, now this was late 2024, I think was like 5% or something. And they've had several revisions to it, then 3, then 1, and now this one negative. So not only has Zillow gone negative on housing, but I would say the trend is pretty consistent. They've become increasingly bearish over the last 6 or 7 months.
And so a few things to keep in mind there, and I'll show their pricing data in a second that usually goes out to my pro members, but they are forecasting for the Zillow Home Value Index. It's their own index that they do for U.S. home prices. Historically speaking, it follows pretty closely to Case-Shiller, FHFA, Freddie Mac, CoreLogic's index. Lately, it's actually been a little softer. Okay. And I have a couple theories there, where one is that unlike Case-Shiller or Freddie Mac, which are only single-family homes, the Zillow index that I share is single-family and condo. And condos.
That's a little wrinkle. Condos, yes.
Yeah. So condo, and so Zillow does have a breakout where you can do just single-family and you can do just condo. And when you do it, their single-family number is still weaker than the Case-Shiller, Freddie Mac, but you will see that the condo's down even more, right? Yeah. And of course, what's happening in Florida is driving down condo prices even more. Yes. And if you look for condo prices in Florida, not only are a lot of places in Florida down 5%, 10%, there's down 15, 20% for condo prices in some of these markets. And especially the older condominium buildings, when you had the Surfside condo collapse that killed 98 people in September 2021, within seconds when it collapsed. And so the state legislature steps in, they pass measures. They want to stop the deferred maintenance on these older buildings. HOAs go up, the special assessments, some of them are up 6 figures, right?
Yeah.
And so a lot of people who own those condos are like, you know what? I'm out. I can't afford this monthly payment. I'm fixed income. And a lot of the buyers during this uncertainty are like, no.
I'm not taking that problem. That's a problem child. Yeah. And don't forget also lenders. Lenders are backing away. I've heard from several people that can't get traditional loans on some of these older condos. So you're talking about paying cash for something. And kind of self-insuring. It's not good. Condos on the water, older condos, not good. Wouldn't touch them.
And so I think the condos kind of weaken it a bit. So Zillow is forecasting negative 1.7% year over year. Do I think it could happen? I think that the Zillow Home Value Index for national home prices could finish down this year. And the reason is, and I went through a lot of the data yesterday. I did it like 12 hours, and then I was actually up till 4 last night, came back. So here's what I found is that you've gone from, of the 50 largest metros in the country, you had 6 of them down year over year 6 months ago, like Austin, San Antonio, New Orleans, places we've talked about, right? It's now to 15. And some of these places are bigger population wise. But the thing that catches my attention more is the fact that on a national basis in their index, national home prices only rose 0.2% month over month between February and March. And I'll share my stats real quick.
Yeah, that's a pretty weak number for the start of the spring selling season. And we've seen that historically. And to your point, that does not bode well for end of year, historically speaking.
Let's see.
There we go. I can. I'm bringing it up right now.
Okay. So here's the table for month over month prices.
Can you make it a little bit bigger? Can you zoom in or no?
Yeah. Let's see. Is it bigger now? Little?
Smaller, actually.
It went smaller? Okay.
It did. Oh, there we go. Now it's bigger. There you go. That's
you
fine.
need, I could screenshot it maybe.
No, it's okay. We can deal with this.
Okay. So anyway, if you look at the top, here's every month, and then here's every year going back to 2000. And these are the monthly prints on a national basis. And you can see that historically, a normal February to March, which every year, this is the most important month that you will see in the year. This is back like 2023, where we are negative and then we pop up, right? And this is like the market in the real world had already started to shift December into January, but then the data really started to reflect it there, and then it carried through the year, right? Well, this is 0.2% month over month from February to March, and normally it's 0.6. The last time we did that was 2010. You could kind of like, 2012 is kind of closer to that. But what gets even more interesting is when you seasonally adjust it, half of all the 50 largest metros were negative month over month between February and March when you seasonally adjust it. So accounting for seasonality, it looks that around half of the markets in the country are in almost like, the trajectory of a market that would finish the year down. Now, maybe it's just down a hair in a lot of these markets, but
still negative. Yeah, still negative.
The problem for achieving, and this is really just about numbers for a second, is the hard part about achieving negative year over year for an annual year in 2023-24 is that so many of the big markets in the country were still rising, right?
Right.
Huge swaths of the Northeast, Midwest were up for prices and actually elevated. And then even some of the pockets of Southeast here and there were still getting some price growth. And California, which had gotten hit hard at the second half of 22, saw a bit of a rebound there. And so you just didn't have enough markets across the country down to get that national aggregate. So I think it's possible.
No, I agree with you. I mean, my call all year has been what I call flat, which if people want to pin me down is -1 to +1. I still feel good, with that call for 2025.
Now, where things could get more bearish on an annual basis, let me run through a theory. Let me run through a scenario with you.
Please.
Right? And this is not talking housing crash. This isn't talking 7-11, right? This is talking 2025. If we have a very muted appreciation in the spring and more of these markets are kind of moving to correction mode, and if we get a shock, an economic shock in the second half of the year into the seasonally weak period, that's where you could have a bigger down year, right?
No, I mean, just to put this in words that we talk about on my channel, we're going to see a lot of demand pull back, even in the luxury market. I've heard more and more luxury buyers pulling back, which, oh, by the way, don't use loans. They pay cash. They're choosing to keep their powder dry. So if, to your point, during the seasonally strong period, we see more people pull back and not play, i.e. Redfin's point, which I'll talk about in a minute, that will leave us in a precarious spot because we didn't get the bump in the spring. Then we go, 4 or 5 months forward. I just talked to more CEOs and they start doing layoffs. We have a real recession. Yeah, I mean, you could theoretically paint a story where 25 is where my call is wrong, and it's certainly more bearish. So there is certainly a lot of risk to any call in 2025. There are so many variables.
And so here's the year over year numbers. If you want to kind of take a look, you have the huge housing boom, then you have the crash, you have things start to stabilize and they roll back over. Then you have the recovery decade, right? And it's actually kind of amazing how like consistent appreciation was in that decade.
Yeah.
And my personal view is that had COVID and all that not happened, we probably stay like on that
Probably
stabilized period. Like we would be in a very different market today if we don't have
correct.
this pandemic housing boom occur.
No, I would tell you we'd be in a lot more normal market. You've
Yes.
heard me say this for years. The housing market is fundamentally broken.
Yes.
We have removed the move-up buyer by a large part. They're trickling back, but they're not back in majority. We broke the housing market, and we're suffering the consequences.
Exactly. We are in an unhealthy housing market, and
Amen.
Bearish or bullish. I think that's just a kind of the people that I roll a little bit about are like the ones who are like, think 2018, 2019 is a bubble, right? Because it's like,
yeah, I've heard that.
But in terms of like today, it's like, in terms of like prices did go up too fast, too quickly, right? In 21, 22, rates being at 2.5%. I mean, does that make sense? We essentially had a Great Depression era level of intervention in terms of like attacking recession. But
money came down from helicopters, to quote Greenspan or whatever.
And then we just didn't have consumers' balance sheets got better through the recession.
Yes, they did.
That's how weird, right, that period is, right?
Well, not only their balance sheet, but their income statements, right? There are a lot of people that went out and got their housing costs, which X taxes is their largest expense. And now they've got their shelter covered at historically low levels. So their income statements even look better.
And so here's still year over year, and you see a lot of the weakness in the Gulf. You see a lot more of the softness, right? You're not seeing a lot of red places. You're starting to see a lot more yellow in a lot of these markets.
Well, let me ask you this question, because again, you look at this data a lot, and I only get to see it kind of weekly. For the last, let's call it the last 12 months, the red and yellow has predominantly been kind of the Gulf, right? Texas to Florida.
Yeah.
To me, looking at this chart today, it does seem like that's expanding north. And the blue areas, which historically the Midwest and Northeast, which were a lot more solid, that's falling away. Am I reading the net change correctly?
Yeah. So California, a few things. A lot of the West Coast saw a bit of a bounce back from the second half of 2022 drop, right?
Yep.
But then since then, things have kind of like they haven't gone back to the second half of 2022 in terms of that environment, but they've been softening consistently. Rising inventory, prices kind of stalling out in a lot of these markets, right? Mountain West, you kind of see that as well. Phoenix, they got a bit of a pop back and stabilize, and now they've kind of weakened a bit more again. Yep. And then you're seeing some of these markets that were still getting appreciation 23, 24, starting to get inventory building. Even in the Midwest and Northeast, inventory starting to build a bit, slowly starting to dig out of that inventory hole. And so here's a look at my table for the 50 largest markets. Year over year national, you can see at 1.2. These markets down, Charlotte to Austin are the 15 negative year over year. Mm-hmm. Most of these, we're not talking about big drops. If you want to look at a place like a Punta Gorda or Cape Coral that's outside of the top 50 in Southwest Florida, you'll see some bigger drops.
Yep.
But it is notable that you're starting to see no appreciation in places like Charlotte, Memphis, Houston, Raleigh, Denver, Dallas. These are big markets. Atlanta, right? And so that's what I was talking about earlier with like this battle with this number. If you're going to get it under zero, you have to have more of these bigger markets be negative.
Well, again, it's certainly on that trend. Again, we get the luxury of speaking to you each and every week. I think it was, 6 months ago or so, there were only 5 or 6 negative. Now we're up to 15 or 16. That trend certainly seems to be going one direction. So it's certainly possible to go negative in 25.
And again, we're talking about the Zillow Home Value Index. We got to see more from like Case-Shiller and Freddie Mac in terms of like if it'd be more widespread. But here's Zillow's forecast. They are forecasting negative 1.7 for the next 12 months. It's not a national price crash they're calling, but I would consider this bearish, at least on 2025.
Yeah, let me ask you this question, because you've been speaking with Zillow probably for a decade or so, certainly more longer than anyone else I know. Have they ever had a negative number?
1 month, one time.
So they've been here before. Okay.
So here's when they did it. Right at the end of 22 into 23, they briefly for like 1 month went negative, and then the
Okay.
market changed and they reversed really fast.
Yeah. Okay.
So
So all right.
they were one of the few in the second half of 2022 that stayed like, hey, we think prices are going to rise in 23. We think prices are going to rise in 23. And then right before the year came, they're like, maybe down 1% or zero.
Okay.
It might have been negative 0.2 or something was their call.
Yeah,
But
it's
this
really tiny, but okay.
and so the reason they're stating is actives rising, greater supply, giving buyers more bargaining power, and affordability challenges suppressing demand. Pretty much, Zillow thinks that strained housing affordability, prices going up 40% during the pandemic boom, rates going from 3 to 6, almost to 7, is just weighing more on the market as we kind of
Amen.
stuck in this environment. And at the end of the day, it's not healthy to go up
No.
like 20%, 10%. We need a second to take a bit of a breather, and especially because one reason that you have like an 80s period where you can still go up like 3, 4, 5% still for growth in a lot of those years. It was also helped by the fact there was more nominal inflation, right?
Right. Of course, the real versus nominal, correct?
Yeah,
Yes.
right now we don't, although there's concerns with tariffs and all of that, there's not, inflation is much lower in today's
Correct.
market. Now it's still a little bit above the Fed's target,
Mhm.
but it's lower. And so I'll show you their forecast. Here's their forecast. You have to really go through to find a market they have positive. Hartford,
So again, as an outsider, not someone in the weeds, they've basically taken the Northeast, which was the last stronghold, and basically said it's going to give up. And once you give up kind of the upside, it makes for a negative year. That makes sense.
So, but even if they're right, like let's say we do go down 1.7, I still think that regional variation will look different. I actually think it would be redder around the Gulf, and still here there would be a fainter blue. Would be my guess.
You want to know what? I'll take the opposite of that. I think Texas and Florida and that Gulf was early.
Mm.
So they may still be down, but it'll be more yellow or whatever that middle term is. If Zillow's right, and I'm not saying they are, I'm going to actually say I think the Northeast and Central show more red, where Texas and Florida have already had the paint. That's just my wild 10-second guess.
The reason I'm hesitant, take a look at the month over months for Florida, Miami, see Jacksonville, see Orlando, Tampa.
Okay.
See, with it to actually have a negative month for March.
Yeah, that's not good.
Like I think you might maybe like let's say you're right, but it might be because you're right in like the 12-month period between like September 25 and September 26, right? And not like I don't know.
Okay. I like it.
When
it's okay. It's okay to disagree. It's all right.
When you go red and when you're actually down for March, that's not normal. Right.
No, I agree. And you've brought that to bear for several years now. That period from February to March, like you talked at the opening, is critical because that's the transition to the spring market. And you're supposed to get the strong numbers starting in March. So I love your chart.
And kind of a crazy way to think about it though, too, is that March of 2022 was actually 10x more appreciation.
Wow.
Yeah, 2 points. I mean, that was just wild.
Yeah, that is pretty wild.
Whenever this is when you know things were wild. When you go back to the second half of 2020, whenever you get this positive of prints at the end of the year.
Yeah, correct. We just blew right through the winter. Yeah.
Yes, exactly. And the thing was, like, some people could be like, well, there was the lock-ins, and so maybe the spring market was pushed to the second half of the year. And people did argue that at the time for appreciation. But if you go back and look at the spring, I mean, there was still appreciation then too.
Yeah, it was still a good time.
So that was a signal we are in a boom. And when actives at the second half of 2020 nosedived,
right,
and prices in the seasonally soft window are up 1.5, that's bigger than any average for a normal peak spring market. And
it was It was a sign of a bull, an
Yes.
unrelenting bull. Absolutely. Well, I'd be remiss if we didn't at least hit Redfin's
Well,
quote, because again, I think it.
one more thing before we jump,
Sure.
before the Redfin, I just want to show, here's year over year where we are now. Here's
Okay.
where Zillow's is. My take on it is, I think while I agree that there's growing softness and weakness in many pockets of the Sun Belt, especially around the Gulf, particularly red hot pandemic housing boom markets, and a lot of these places like the Charlottes, the Atlantas, right? These were places that were always forecasted in a lot of models to see a softening and a weakening and maybe even go in correction. It's just slowly kind of taken more time to get there. But I think that Zillow is too bearish for 25 on many of the markets in the Northeast and Midwest, just because when you look at the active inventory, a lot of these,
the Northeast is just not there. It's just not there.
and even when you look at Zillow's model, like here's their buyer sellers market, they are rating the Northeast as strong sellers.
Hot.
A lot of their models. So it's like, I just have a hard time believing and another thing is, in a lot of their models, while their national numbers have performed well relative to other forecasters, the regional stuff has kind of been a little funky at times.
Been a little wonky, huh?
Yeah, and even into this year, they were still forecasting growth for Florida and had them in like
Whoops.
Yeah. So okay, and well, actually, one more thing. I know I keep jumping.
No, it's fine.
Fannie Mae still thinks plus 1.7 for 25 is measured by the Fannie Mae home price index, and Wells Fargo is still plus 3 for their case for the year.
Well, not to throw in one more thing before Redfin, you did an excellent summary of pricing forecasts. I believe there was somebody, I forget their name, that was up 10%, double digits. I think they've had a second revision down to plus 5. Have we got an update from that company? And forgive me, I don't remember the name.
Apollo Global Management, I believe is their name. No, they've cut it once, but if you go read their economic commentary, because of the tariff stuff, they've really changed their tune on a lot of things. They were pretty bullish, and now on a lot of things they are much more bearish. But I think we were right to kind of be like, hey guys, what do you guys?
What are you smoking?
Yeah, and the thing is, because at a national to be up 10%, that's crazy. The very top echelon percentage tile wise for national appreciation, and if you go up 10%, I mean some are up 20. So we
couldn't get there. Well, let's close with Redfin, because again, I think it's really odd that both Zillow and Redfin have gone so negative on housing. Let me actually remove this so we can get this out of the way. Yep, there we go. 24% of Americans, according to Redfin survey, are scrapping plans to make major purchases like homes or cars due to tariffs. Now, folks, this is important. One of the things that we have seen, at least with automobiles, is at the end of the month, we actually saw automobile inventory crash. It went from 91 days to 70. What happened there is they pulled forward demand, but now we are seeing conscious decisions not to buy. We are seeing the wealthy not buy. We are seeing the people just stay put. The level of uncertainty in the market means a lot of people will simply not apply for a mortgage, not write an offer. It means inventory is going to go up. So what does all of this mean? It means that what I've said for months now, 2025 is going to be the year of the investor. It is our time to do the work, have a buy box, find or create the motivated sellers, get seller financing, do creative financing. This is the year that if you do the work, you can find the deal of a decade. I firmly believe and have proven time and time again, the deal of the decade comes around once a year. So let Redfin, let Zillow be negative. Let them scare away demand. In fact, I hope they go super negative. I hope we get 10% mortgages so that investors can feast on amazing deals. Lance, where can people find you?
Yeah, they can find me at resiclubanalytics.com. They can sign up for my newsletter there. I have a free newsletter, and I also have a premium product for more research. They can follow me on Twitter at NewsLambert. And then also, I'm now on LinkedIn. So just Google Lance Lambert to find my
Folks, do me a favor. If you're on my channel and you haven't gone to Resi Club Analytics, do that today. His free stuff will change your life. And if you are actively shopping in a market, not only do you get additional articles, but you get access to this guy's data. And trust me, if you have a buy box, a city, a location you're investigating, he has more data, more history than anyone else on the planet. Go get the pro version. And of course, I follow him on Twitter. That's where I get lots of my updates. Lance, you're amazing. Take care.
Thank you, Zuber.